Passive income is money earned with minimal effort, and Dividend Aristocrats, elite S&P 500 stocks with 25-plus years of consecutive dividend increases, are a proven way to achieve it. These companies, like Coca-Cola and Johnson & Johnson, combine stability with growing payouts. In 2023, the S&P 500 Dividend Aristocrats Index outperformed the broader market by 5% during volatility. This video explores how to harness their power for long-term wealth. Dividend growth investing focuses on companies that consistently raise payouts, compounding returns. For example, Procter & Gamble has increased dividends for 67 straight years, turning a $10,000 investment in 1990 into over $200,000 today with reinvestment. Studies show such stocks deliver 9% average annual returns, beating non-dividend payers. The key? Reinvesting dividends to buy more shares, accelerating wealth snowball style. Dividend Aristocrats shine in downturns. During the 2008 crisis, they fell 22% versus the S&P 500's 37% drop, recovering dividends faster. Why? Mature firms prioritize shareholder payouts. Even in recessions, 98% maintained or raised dividends in 2020. Their average 2.5% yield acts as a cushion, while growth stocks often crash harder. This resilience makes them ideal for risk-averse investors seeking steady income. Selecting Dividend Aristocrats requires strict criteria: 25-plus years of payout growth, strong balance sheets, debt to equity under 60%, and sustainable payout ratios below 75% of earnings. Tools like S&P's official list or screeners, e.g. FinViz, filter these traits. For example, Lowe's LOW has a 40-year streak, 2% yield, and 35% payout ratio, ideal for long-term safety. Always verify growth metrics beyond just the streak. Diversify across sectors to mitigate risks. Dividend Aristocrats span healthcare, example, Johnson & Johnson, consumer staples, PepsiCo, and industrials, 3M. In 2022, healthcare aristocrats grew dividends 7% despite inflation, while tech dividends lagged. A balanced portfolio might allocate 30% to defensive sectors, staples, utilities, and 20% to cyclical, industrials. This hedges against sector-specific downturns while capturing growth. DRIPs, dividend reinvestment plans, turbocharge returns. If you'd invested $10,000 in ABBV in 2013 with DRIP, your holdings would now be worth $48,000 versus $32,000 without reinvestment. Compounding works silently. Even modest 3% yields grow exponentially over decades. Brokers like Fidelity offer automated DRIPs, turning payouts into additional shares. Time and patience are the only requirements. Qualified dividends are taxed at lower capital gains rates, 0 to 20%, versus ordinary income up to 37%. For example, $50,000 in qualified dividends may owe $7,500 in taxes versus $18,500 a salary. Hold stocks 60-plus days to qualify. Note, REITs and preferred stocks often don't qualify. Tax efficiency boosts net returns. A 3% yield post-tax beats a 4% taxable bond for high earners. Stagger investments across aristocrats with different payout schedules for monthly cash flow. For instance, AT&T February, May, August, November, paired with Realty Income monthly, creates consistent income. Aim for 12 to 15 stocks across sectors. Diversification prevents reliance on one company. A $500K portfolio yielding 3.5% generates approximately $1,458 per month. Tools like Dividend Calendar track payment dates for optimal scheduling. Meet Sarah, a retiree whose $800K aristocrat portfolio yields 4%, $32,000 per year. She invested $300 per month for 30 years in stocks like Exxon and Target, reinvesting dividends. Now, her dividends cover living expenses, even during market dips. Her key lesson? Start early. Her first $10,000 grew to $250,000 via compounding. Her portfolio's 2.5% annual dividend growth outpaces inflation. Securing her lifestyle. Dividend investing isn't get-rich-quick. It's get-rich-surely. A $1,000 a month investment in Aristocrats at 7% returns grows to $1.2 million in 30 years, yielding $42,000 per year. Time trumps timing. Even the 2008 crash is a blip in decades-long charts. Like planting a tree, start now. As Warren Buffett says, the stock market is a device to transfer money from the impatient to the patient. Your future self will thank you.